News to watch out for today with BlinkX. US stocks climbed as traders wager the worst of the banking sector turmoil has passed, while Treasury yields climbed after the latest inflation reading cemented bets for a Federal Reserve rate hike next week. The dollar was little changed versus major peers. Elsewhere in markets, oil extended declines. Gold slid after rising in the three previous sessions as traders turned to heaven assets. US consumer prices rose 0.4% in February, meeting economists' forecasts. The closely watched core CPI number, which excludes food and energy, increased 0.5%, just ahead of the medium estimate of 0.4%. The two-year note, the most sensitive to interest rates, climbed over 30 basis points to 4.33%. Plunging rates gripped Wall Street attention yesterday when the yield dropped more than a half percentage point in the biggest move since the 1980s. Treasuries have been whipsawed in recent days, with a measure of volatility climbing to the highest since 2009, and banking shares plunged as the collapse of Silicon Valley Bank and two other US lenders prompted Vegas the Federal Reserve will pause its hiking cycle and even cut interest rates to stabilize the financial system. Here's what else Wall Street is saying. Although the number was higher in core MOM than expected, it is probably not sufficiently so to corner the Fed into hawkishness the next meeting. Therefore, risk assets are able to breathe a sign of relief here, as the Fed probably has the option to go easy at the next meeting if they feel the banking system requires it. Peter Chatwell, head of global macro strategies trading at Mizuho International, said. The CPI number is no game changer. After the events last week, a 50 BPS appeared unlikely going into the data print today, and the slightly stronger than expected core inflation print puts speculation of a Fed pause to a rest. The Fed is on track for another 25 BPS hike next week. Equities should rebound somewhat as the Fed becomes more predictable for now. But the impact from higher rates on the economy is just starting to be felt and will likely become more and more visible as the year moves on, he added. Stay tuned with Blinks.